Hi guys, how's it going? It's XOXO and welcome back to my YouTube channel. If you keep up with the news, you would know that the South African Reserve Bank reduced the repo rate by 25 basis points, causing changes to the prime lending rate and the repo rate. Currently, the prime lending rate is at 11% and the repo rate is at 7.5%. So in this video, we're going to look at how people who owe the bank are affected. These are people that borrow money from the bank, and the people that save money with the bank, these are people that the bank owes money because we expect interest income, and the people who invest in the stock market because interest rates are a factor in the stock market. They cause changes to the share price, of course offsetting stocks, not all of them. So let's first understand what the repo rate is and the prime lending rate is. So now, these banks don't always have money. They have to go borrow money so that they can borrow somebody like you and I money when we need money, right? So they go borrow money from the Reserve Bank, and Reserve Bank charges them interest, and this interest is called the repo rate. And then they come back and they borrow you and I money and charges us interest, and the interest is called the prime lending rate. So remember, a bank is a business. They're in the business of making money, so they have to make profits. So what they do is that after they are charged interest by the Reserve Bank, they have to come and charge us a bit of a higher interest rate so that they can be able to pay back the Reserve Bank and keep some money so they can survive. So these are actually good news for people that owe the bank. So if the bank owes you, if you save with the bank, the situation does not favor you in any way. Obviously, if you owe the bank, your interest is going to decrease and you will be able to pay off your debts a little bit quicker. And if you really look at the positive side of this whole thing, you should keep tellers on you so that you can be able to pay off your debts a little bit quicker. And I talked about paying off debt as a financial goal in my previous video. So maybe the fact that interest rates are reducing should encourage you to pay off your debt, because right now debt won't be as expensive. But this only applies if your interest rate is variable. Remember, we have variable interest rate and fixed interest rate, and fixed interest rate remains unchanged, and this only disadvantages you when interest rates are cut. But when they're increased, you are safe because you won't be affected. And variable interest rates changes, right? So now that interest rates are being reduced, you are actually at an advantage because your interest expenses are not going to be high anymore. And in as much as now with reduced interest rates, debt is a bit more cheaper, this should not be seen as an opportunity to go take unnecessary debt. And I say unnecessary debt because not all debt is a bad debt, right? You can take debt to go purchase assets that are going to generate you cash. That is a good debt. But when you're going to take unnecessary debt, that actually is a bad financial habit and it should not be encouraged. And an example of unnecessary debt in this case would be maybe to inflate your lifestyle, right? And this is something that is actually quite common for people to inflate their lifestyles, right? Simply because your income is increasing or you're not getting into a new job, you feel like you need to upgrade your lifestyle, but then you actually forget that you are not actually managing your money well, you're just inflating your lifestyle. So that is a very bad habit, and it forces you to go and take on unnecessary bad debt, because you are taking debt because you actually see that your income, either it has increased or not, does not cover your expenses, and you have set this high standard, this high lifestyle that you have to maintain, but you don't have the income to do so. So like I've said, that now that debt is more cheaper, it should not be seen as an opportunity to go and take on more debt, especially to find things like your lifestyle simply because you want to keep up with the Joneses, right? That should not even be something that a person must consider. If you really see that your income is no longer covering your expenses, then maybe you need to take a different approach where your finances are concerned. And this should not include debt. This should include you living below your means, actually way below your means, and changing your life so that you can just put your finances all together. But debt should not be an option. And if we're just going to be quite frank, debt can be addictive, right? Because sometimes it's seen as free money, and I've had this conversation with someone. They were drowning in debt, but they got to get out, and what they said was, you see this as free money. Somebody's like, come and take this money for free and you'll pay it back. So in the moment you see it as free money, and now we're talking about instant gratification because you just click apply and the money comes into your account. But that actually is a very bad habit, and it's so sad that later you find that it's very difficult for somebody to repay the debt or even drawn more into that debt because they are failing to even keep up with the installments. So like I say, and I will emphasize, this should not be seen as an opportunity to go and take on more debt. And it's unfortunate that we are highly indebted as South African consumers simply because inflation is going up, but then our income is not going up, so it is not keeping up. So we have to take more debt to make up the shortfall. It's just unfortunate. However, let's not be addicted to debt and take on more. And maybe then we should look to invest in cash generating assets like property, because it is now cheaper to borrow money. And I read on some article that interest rates may be reduced even further. So if you have always wanted to invest in property and take on debt to finance it, maybe this is the time. However, go consult with your mentors and coaches. This is not a financial advice for you to go and take on debt to buy property. And like I said, this whole situation of interest rates being reduced do not favor people that save with the bank, that the bank have to pay interest income, right? Because now, if we are going to talk financial goals, when we say we're investing with the bank, either in a fixed deposit account or an accessible account, there is an interest rate that the bank promises you that if you save my money with me for this period, or if you just save my money with me, I'm going to pay you maybe 7% or 8%, right? That is going to reduce. And if you think about it, that is actually tampering with your whole financial goals, because to just give an example, if you now save 10,000 with Bank A and it's saying I'm going to give you 10% interest rates, you were expecting that at the end of the year you're going to have 11,000. Your money would have grew by 1,000 rands. But now that is not going to be your reality anymore, because they have reduced interest rates. This is why this whole thing is putting somebody who saved with the bank at a disadvantage, because things are not going to go the way in which you hoped that they would go. It's just unfortunate. But now if we are going to talk about growing your money, the bank is not the place for that, right? Because the bank is a business and they will do anything, right, to make sure that they remain profitable at the end of the year or whatever period. So if they now keep on promising you high interest rates, they are actually killing their own businesses, right? But I'm not saying that we should stop saving with the bank. We have to, because at the end of the day, we have to save, and we cannot just put our money and put them under the mattress because we can't save with the bank. But maybe what you can look to do is to start investing in the stock market, where you know that the returns are going to be way higher than inflation and way higher than the interest rate that the bank promises you. And you know, on this channel we are heavy on investing, right? Because if I could, I would encourage everyone to invest in the stock market. And it's because I do invest there and I see that the returns are actually quite good, and you don't even need to be an expert, right? There are things called ETFs where you can just start investing in them without having to crack your head. Leave your money there. After a year you will see a huge growth, right? At least 10%, depending on the type of ETF that you have chosen. Of course, that is a factor. So you can save money and invest at the same time. And I actually had a masterclass on Saturday, and somebody asked if they should save or invest, you know, and that is something that people are so confused about as to whether they need to save or invest. And what I can just say is, obviously you have to look at your life and see how much you need to have in your savings, obviously talking about emergency funds with this one, and then look to push that, right? And if you are in a position where you can save and invest at the same time, do that. That's what I do. I save while I am investing, because if I'm just going to focus on saving, I'm missing out on the potential returns that the stock market can give me, right? But one thing for sure, guys, is that the stock market is forever going to be here. If maybe you need to pay off debt, focus on that. You need to build your emergency funds, focus on that, and then you will see investing later. But again, if you are in a position where you have enough money to be able to save or even pay off debt and invest, do it. So now let's talk about how interest rates affect the stock market. And like I've said, not all stocks are going to be affected by the interest rates, right? So let's unpack it a bit. When the interest rates are high, people don't have enough disposable income to go buy, right? So for example, let's talk about retail companies, right? Now these companies make money by us going to buy clothes or buy food. So when now interest rates are high and we don't have enough disposable income because we have to pay more on our debt, we are no longer affording to buy as much items as we used to, right? Now these companies suffer. The companies' earnings get to suffer because they're no longer generating enough revenue or more revenue that they used to. So what happens is, in periods where interest rates are high, such stocks tend to suffer simply because the companies suffer. Remember, we have a stock and we have a company, and a stock is a reflection of what is happening in the company, right? So when now the earnings of these companies get to reduce simply because we don't have enough disposable income, the stock gets to be affected, because it's a thing of, okay, at this period this company is not profitable, so I will invest, maybe I won't invest. It's something that you and I decide based on our judgment, right? But usually what happens is that this company's profits don't get to be as high as they anticipate simply because of this interest rates being high, right? So now let's look at Mr. Price's earnings report that they published last year after the 6 months period, which ended end of September. And if you are a stock market investor, you always have to keep up with what is happening with the companies that you invest in, right? Now these companies, every 6 months they publish the earnings report where they actually tell you what happens with their profits. Did they increase, did they decrease, and what actually happened? So looking at this one of Mr. Price, they do highlight that they have reported an increase of 5.2%, right? And then they continue to say that while there were macroeconomic positives of no load shedding, increased political stability, and the appreciation of the rand, the earnings performance during the period is reflective of the continued constraint on consumer affordability levels. Negative real wage growth and low disposable income growth remained weighed down by the effects of previously prolonged periods of high inflation, elevated interest rates, and high consumer debt servicing levels, right? So if you think about it, like I've said, that we don't have enough disposable income anymore. We don't afford as much as we used to, right? Now these companies don't get to capitalize on that, because if we don't afford to buy more products, what's going to happen? They're not going to make more money as much as they used to. So if maybe you invest in retail companies and you see that the time where the interest rates were a bit high, they were not performing well, you did not have to sell. You just had to understand why, the period that they are in, and what is affecting them. And that's why I say all the time that you need to understand the business, because when we invest in the business, we buy the business. So you have to understand the nature of the business so you are able to tell which factor is most likely to affect the business and what you're going to do as an investor. And that is how interest rates actually get to affect the stock market. So now that they're a bit more reduced, let's hope that these companies will perform a bit better. So we will see how it's going to be like when they report on their annual financial results. And that, guys, is how interest rates affect you and I as a consumer and as an investor. Thank you so much for watching. I hope that you've enjoyed it and it was a bit more informative, and I will see you in my next video. Bye.